So just to give you a little bit of background about me, I started doing accounting work when I was 8 years old. So I've been in this for a long time, 30 years of professional experience, but we're going to jump right into it. Okay. First of all, let's talk about why this matters. And why this matters and why I'm so happy to be talking to you folks who are younger is a lot of people struggle with taxes. And they don't struggle because they're irresponsible with taxes. It's that no one's ever explained to them the basics of taxes, how taxes work. And I deal with this every day in my practice. People come in to see me and they really don't have a good idea of what taxes are. They know they get a paycheck, and from that paycheck, they don't quite get all of their money. I liken it to when you go to the ice cream stand and they hand you an ice cream cone, but before they hand it to you, they take a couple licks of it. That's what you get with your net paycheck. But today I really want to fix that. So let's get right into it. Here's going to be what you're going to learn today. Today, at the end of the time, if I've done my job correctly, you're going to understand how to read a paycheck. You're going to understand what is a W-2 form. You'll understand what tax filing actually means. And actually, I'm going to talk to you about how to file taxes for free. And that one's a little bit complicated, but we'll get to that at the end of the session. So let's get right to it. Raise your hand if you have a job. I would just like to know if anybody has a job out there. It looks like a lot of you have jobs, which I say congratulations. It's very cool to have a job. So if you've got a job, guess what? You've already paid taxes. So you're already paying into the system. So let's talk about what that looks like. So, and this is probably not foreign to anybody, but I want to get into a discussion of what's called gross versus net pay. Gross pay is what you earn before your employer takes out any deductions. If you're working by the hour, right now in Delaware, the minimum wage is $15 an hour. So you've worked a certain number of hours, and in those hours, you've earned a pay based on those hours. That's what we call your gross pay. So that's the big number at the top. That's the part that makes you upset when you see what's at the bottom. The net pay is that's what actually hits your bank account. If you're doing direct deposit or if you're actually getting a paycheck, that one will be what hits the actual, the check that you get that you take to the bank. So same work, but a different number. And that number hurts a little bit. So let's get to the next slide here. There we go. So I want to give you an analogy to kind of talk about how do we look at this gross pay versus net pay. Think about it in terms of a menu when you're out to eat or you're at one of the fast food restaurants. The gross pay, that's the price that's on the menu. That's what you're saying. Okay, this hamburger is $2. This is that. The net pay is what's left over after the taxes and the tips. So I hope that tried to explain that a little bit, but that's the big difference between your gross pay and your net pay. And the thing is, you got to live on your net pay because that's what you actually have in your bank account. That's what you can actually spend. So let's talk about the taxes that are taken out because a lot of people don't understand all the pieces to that. So when you get your gross pay, it's going to start at the top. And I'll show you an example here in a second. But it's going to start with your gross pay at the top. Then from that, you're going to pay federal income tax. You're also going to pay state taxes. Now, depending upon where you live, in Delaware, we do have state taxes. And in some places, like the city of Wilmington, there's actually a local tax, what they call a municipal tax. So those are the taxes that you're going to pay. You're going to pay your Social Security tax, your federal tax, your state tax, and local tax. So there's a lot of taxes, right? Let's talk about what FICA is. Now, FICA, you might see that on your pay stub. FICA is actually Social Security and Medicare taxes. And that's something that the U.S. government requires that every single person pays, except for your instructor there who is exempt from that when he was on his J-1 visa. That's one of the things that and he can talk to you about what that looks like. But most people have to pay Social Security and Medicare tax. That's required from every paycheck. Well, let's talk about what that looks like. So Social Security, if you have a grandparent or maybe a parent who's retired, when you retire, you reach a certain age, you start to collect Social Security benefits. That's sort of like your pension, if you will, that the government gives you so that when you retire, you can afford to pay your bills. Those funds are for retirement. They're also for disability. If you have a disability, for something happens, like maybe you get hurt in an accident or you have any kind of head trauma or anything like that, you can actually apply for disability benefits. Those disability benefits are paid through that Social Security fund. But really what you're doing here is you're putting money away for the future. I say here in this slide, You're paying into your future. You're putting away money today. Now, it doesn't feel like you want to do it. They kind of make you do it, but that's what you're doing. The other side of this is Medicare taxes. And if you watch the news, you've heard about medical insurance. Well, Medicare taxes are what fund healthcare for older Americans. That's when you're retired, you may not have a job anymore. So what's going on is the U.S. government steps in and provides you with healthcare coverage. Again, this is required from your paycheck. So again, now we've got your gross pay, we've got your federal taxes, we've got your Social Security, your Medicare, and your state and local income taxes. Let's talk about the first one that we mentioned. That's your federal income taxes. That's money that's sent directly to the federal government. This is what messes up a lot of people. As you work, you put a certain amount aside, your employer puts it aside and sends that to the IRS. It's sent ahead of time. And you got to think about it like this. It's really a deposit because the IRS isn't going to know until the end of the year whether you've paid enough in or whether you need to pay them more. So as you're working, you're making an estimate. And we're going to get to how all that works, but you're basically telling your employer, hey, here's how much I want to have taken from my paycheck so that by the time we get to the end of the year, I don't owe the IRS anymore, but it's a deposit. And then in addition to that, we talked about this, you've also got your state and local income taxes. Here's the cool thing a lot of people don't know. Some states don't have income taxes. For example, the state of Texas does not have a state income tax. The state of Florida does not have a state income tax. The state of Washington does not have a state income tax. But it works the exact same way as the federal tax. Again, you're prepaying it, an estimated tax as you go. All right, so let's get into our real example. I told you I'd share with you some real numbers today. Let's say you've got a part-time job. A lot of you raised your hand and say you had a part-time job. And let's say you're working 20 hours a week. So if we take those 20 hours, we multiply that times 15. And listen, here's the fun thing about being an accountant. I can count this on my finger and toes. Just being funny. But anyway, so your total gross pay would be $300. Does everybody understand that so far? That's the number at the top. But here's the problem. Then you've got your deductions. So your actual take-home pay could be anywhere from $250 to $270. I remember, I'll give you a great example of this. My youngest son, who's now 24, he was working at Jake's Hamburgers. And I'll never forget the first time he got a paycheck. He got his paycheck. He was all excited. He had been keeping track of his hours. And he said, Mom and Dad, I'm going to be able to buy this. I think at the time he was into the game systems. And he said, I'm going to be able to buy this awesome game with this money. And I'll never forget the day he got his paycheck. He was crying. He was so upset because he said, Dad, they shorted me money. He learned a valuable lesson. And that is you don't get your gross pay, you get your net pay. And I had to explain to him that's normal. So if any of you are working now, you probably feel this. I worked this many hours. I should have gotten this much, but what I actually got was a lower number. Let's talk about why it's lower. The reason it's lower is you've got to pay taxes. You've got to pay those federal taxes, the Social Security taxes, the Medicare taxes, and you're paying those throughout the year because the IRS, the U.S. government, wants their money as you go. They don't want you to pay it all at the end of the year. They want you, as you're getting paid, they want to get their money at the same time because that's how they pay for roads. That's how they pay for benefits for other people. That's how they fund the government. So they're automatically withheld and paid throughout the year. That's the reason that your gross pay is a bigger number and your net pay is a smaller number. All right, let's get into how this all works. Let's start with what is a W-2 form? Let me ask for a show of hands. Does anybody have ever seen a W-2? Have you gotten a W-2 yourself? So we've got a couple of hands up. So let's talk about what the W-2 is. So as you're working, your employer should be giving you what's called a pay stub. On that pay stub is here's what your gross earnings were, here's all the taxes we collected, and here's what your net pay is. Well, the W-2 is what they give you at the end of the year that summarizes that. It's kind of like the complete summary of what you've worked all year. So on that W-2 form, which is going to be important because you're going to use that when you go to file your taxes, it's going to show all of your earnings for the year, whether you're paid weekly, bi-weekly, monthly. It's going to add all those up. It's going to show all those together. It's also going to show how much you paid in federal tax and Social Security and Medicare tax. Think of it like a receipt for year end. This is what you had all year long. This is what you were able to pay in taxes. And this is what you were able to keep for yourself at the end of the year. That's what a W-2 form is. And that form is what you're going to use to prepare your taxes. Okay, Let's talk about what's on the W-2 form. There's several boxes on the W-2 form, and I'm not going to lose you in the minutia of this. I'm just going to talk to you big picture. Federal wages, that is how much you actually earn for the year. That's going to be what they usually put in box 1. Then you're going to have how much federal tax was withheld. That's based on a form we're going to talk about in a second that you gave your employer. In addition to that, you're going to see Social Security taxes, you're going to see Medicare taxes, and you're going to see state taxes if you live in a state that has state income taxes. All right, so does everybody get that so far? If I'm going too fast, feel free to slow me down. And actually, right now would be a great time if anybody has any questions. If you've got a question right now, I can handle those before we move into the idea of filing versus paying, which is where a lot of people get hung up. Okay? Then let's talk about the difference between filing and paying, because a lot of people don't understand the difference. And there's an important distinction here. Filing is when you're doing the paperwork. We talked about that a minute ago. When you get your W-2 form, all year long, you've been figuring out how much should I be paying in federal and state tax. Like I said earlier, that's an estimate. So when you actually get to the end of the year, you've might have heard the term called tax season or tax filing. Right now, this is what I'm doing. I'm in the middle of tax season for me because all taxes for personal individual tax returns have to be filed by April 15th. So they give you some time after the end of the year to collect your information because you've got to get that W-2 from your employer. If you've got a home, there's some documents you get for that. If you've earned interest from a bank account or you've got any kind of other investments or savings, those are all the things that you're going to assemble. So that part is called filing. That's where you're actually doing the paperwork. You're going to get all your documents. You're going to get your forms. You're going to fill in the blanks of all the pieces of the puzzle that happen throughout the year. That's the filing piece. Unfortunately, the next step is paying. There are times, and we'll talk about this in a second, when you owe the IRS more because what was withheld from your pay didn't match what you needed to pay for the year. So the difference between filing and paying is doing the paperwork. That's putting all the numbers on the paper. Paying is when you send the money in that you owe. They're not the same thing, but you have to do both pieces. You both have to file and you have to pay. But if you understand the way this works, you got to file first or figure out what you have to pay first. Not the same thing. So let's talk about tax time because this is what fouls up a lot of people. All year long, your money is withheld. And as it's being withheld, your employer has an obligation to send that to the state and sends that to the IRS. So then what happens at tax time, you compare what you paid in versus what they say you should owe. And the reason that is we'll get into this in a second. There are certain things that you can deduct from your income to help you save on taxes. There are certain credits that you can take based on your situation. But at tax time, what you're really looking at is, okay, here's what was paid in through the year. Here's what I actually owe. What you owed versus what you paid. That's how tax time really works. It's no more complicated than that. You've been paying in throughout the year. Now you figure out, okay, what was I supposed to pay in? Let's talk about the next step to this. Refund or bill. Now, as soon as I use the word refund, everybody says, yeah, that's what I want, a refund. Everybody wants a refund. A refund basically means that throughout the year, you paid in too much. Your withholding was more than what you actually had to pay. That's generally a good thing. If you didn't pay enough in, then guess what? You owe. So the IRS is going to want your money from you, either get it at the beginning as you go, or you get it at the end. It's really that simple. That's the difference between a refund or a bill, the amount that you owe the IRS. Let's talk about refunds, because for 30 years, I've been doing taxes professionally. And every year, people are so excited they're getting a refund. Oh, it's so fantastic. And maybe your parents or people you know around you, they jump up and down. They're so excited they're getting a refund. But here's the thing I want you to understand. That refund is not free money. It's your money. You've been paying in that money all year long, in that paycheck, in that not getting your full gross pay. You've been paying that money in all year long. Now, there are some exceptions for credits, and we'll talk about those in a second. But generally, the money you're getting back is your money. It's money that you've been putting aside all year long. So if you get to the point where you do your tax return and you're getting a refund, It's great that you're getting a refund, but understand you're getting your own money back. The goal with all of this is to not be surprised. If you want to set up your withholding so that you never owe, that's fantastic. I'll talk to you in a second about how to do that. But it's not found money. It's not free money. It's not you hit the lottery, everybody's excited. You're getting your own money back. So let's talk about where do you file a return. We talked about the difference between filing and we talked about the difference between paying. And I'm going to use an analogy here of a scoreboard. You go to a sporting event, the scoreboard tells you who's winning, what quarter it is, what inning it is if it's baseball. Well, the scorecard for personal taxes is what's called a 1040 form. You may have heard of that form before. It's just a fancy way of saying this is the document we're going to use. That's what we call the main federal tax form. It's called a 1040. And on that 1040, you're going to fill in the blanks. Here's what my income was. Here are my deductions. Here's what I paid in. And then the bottom line is, do you overpay? Are you getting a refund? Did you underpay? Guess what? Now you need to pay them more, or you break even exactly within $0. I'll be honest with you. I've been doing this for 30 years and only one time have I ever seen a return that was exactly a zero. It was kind of a cool thing. I'd never seen it before, but generally people either going to get a refund or they're going to owe. An effective tax plan is when you manage that to where it's a small amount. When I work with clients, when I'm helping them with their taxes, my goal is to have them get either $100 back or owe $100 because most people, $100 isn't going to be a big issue for them. So if I can get them that close, then that means they're not going to have a big surprise at tax time. Let's talk about the tax deadline. So I mentioned that taxes are paid on the calendar year, basically January 1st to December 31st. So whatever you work throughout the year, that's when they're assembling that information from your pay stubs. And then your employer, after the first of the year, has until the end of January to create what's called that W-2 form. We talked about that a few minutes ago. And then you've got generally till April 15th to file your tax return. Now, there are exceptions to that. You can file an extension if for some reason, maybe you're ill, maybe you've had something happen in your family, you don't have all your documents together. You can file what's called a tax extension that will extend the filing deadline for an additional 6 months. So now it's not due April 15th, now it's due October 15th. But here's the thing I want to warn you about. You still owe the money on April 15th, whether you file or not, which messes up a lot of people because they say to me, Ralph, wait a minute, I filed an extension, so I don't have to file this return until October. But the way the IRS code works is you owe them on April 15th. Now, a lot of people say, well, okay, but Ralph, I don't owe anything, so why do I need to file? If you earned income that was reported to the IRS, then you need to file a tax return. Now, it could very well be that you don't owe them, they don't owe you, but you still need to file even if you don't owe them any money. The reason you want to do that is, number one, you want to stay in compliance. I'll share something with you a little funny. Filing a tax return can actually lead to criminal charges. There's a famous guy named Al Capone. Al Capone was a gangster. The reason that Al Capone got in trouble and ended up in jail wasn't the things he was doing illegally, it was tax evasion. Tax evasion means that you were making money, but you weren't filing taxes. Now, I don't say that to scare you, but that's the kind of thing that the IRS can come out and actually arrest you for. It's called tax evasion. So you want to make sure you're filing your tax returns because you can read the news. Every year, the IRS picks out a couple of people to make as their, here's an example of who didn't file their tax returns. And even if you don't owe, you may need to file a tax return. All right, let's talk about some of the things that change because you're probably thinking, wait a minute, Ralph, you said my employer withholds money and then at the end of the year, I've got to do a return. Why would there be a difference? Let's talk about this because here's where you can win on your tax return. Credits and deductions. Every single person that files a tax return gets what's called a standard deduction. What that basically does is it reduces the amount of income that gets taxed. So the IRS, the state says, okay, great. If you're working, you get to deduct a certain amount of your income as a standard deduction because they realize it costs money to put gas in your car. It costs money to buy groceries. It costs money to pay all your bills. So they can't tax, or they don't want to tax every single dollar that you make. So you get this thing called a standard deduction. Most people use that automatically. So for example, if you're a single taxpayer and you've earned income during the year, generally your standard deduction is just over $13,000. So basically what I'm saying to you is the first $13,000, I don't have the exact number, but just pick $13,000 as a number. The first $13,000 that you earn in any calendar year, there's zero tax on, at least federal tax. You're still paying Social Security and Medicare tax, but there's no federal tax on that. Another term you might have heard is called itemized deductions. Itemized deductions is the other things you could deduct. Maybe your folks have a mortgage. You can deduct mortgage interest. Maybe you have property taxes. Maybe you give money to charity. All of those things, or if you have medical expenses over a certain amount, all of those things you can add together to see how much that deduction is. And here's the cool thing about taxes. The IRS gives you a certain number standard. Not everybody gets that. But if your itemized deductions are bigger than that, because you've got more deductions, because like I said, maybe you give a lot of money to charity, you have a big mortgage, you pay property taxes, you could actually do what's called itemized deductions to give you a bigger deduction. But the whole idea is it's a way for you to not pay taxes on all of your income. Here's the cool thing though. There's also things called credits. Tax deductions reduce the amount of your taxable income. So let's just use a simple example. If you had $33,000 worth of income and then you apply the standard deduction of $13,000, that means that your taxable income would be $20,000. And then based on that $20,000, you pay whatever percentage you fall in for taxes. Dollar for dollar thing. But here's the beautiful thing about credits. Credits actually reduce your taxes dollar for dollar. As an example. So if you think about it, a deduction lowers your taxable income, but credits actually chip away at the tax directly. So credits are a better thing. Credits are things like education credits. If you are going to college, there is what's called the American Opportunity Tax Credit. These things are actually dollar for dollar offsets. If your parents are claiming you as a dependent on their tax return, there's a thing called a child tax credit that reduces dollar for dollar the amount of taxes they need to pay. But here's the thing you got to understand. These things have significant rules because there's benefits related to those. So you've got to understand the credits. You got to understand what that means because there's certain things that you have to do to qualify for those credits. For example, like the education credits, you have to be enrolled full-time in college. You have to be under a certain amount of income. You have to be taking so many credits. But if you qualify for that, that reduces your tax dollars dollar for dollar. So it's a great thing. Here's another one. You might be able to deduct student loan interest. I know some of you may be going on to college. One of the things you may do when you go to college is you may be paying student loan interest at some point. That may be deductible at some point. So that's another thing that, again, that's a tax deduction. All right, let's talk about how to file because we talked about, okay, how do I figure out what my paycheck is? We talked about what is a W-2. We talked about what taxes are. Let's talk about what do you actually do? How do you make this happen? Now, up to this year, you could go to irs.gov. That's the U.S. government website to free file. They've changed that now. There is no free filing through irs.gov, but there are places to file your tax returns online for free. Here's the big thing I'm going to tell all of you folks. Chances are most of you are dependents of your family still. So make sure you have a conversation with mom and dad, whoever your caretaker is, and say, hey, I've got to file a tax return, but I want to make sure that we're on the same page because you don't want to rush out and do your tax return and then cause a problem for your caretaker because they may be entitled to take a deduction for you. So, and I see this happens all the time, happens a lot of times with high school juniors and seniors. They got their first job and they're so excited because all their friends are getting a tax refund and they want to get their money back. And they have to be really careful about that because there are certain deductions that you can't take on your tax return if you're still a dependent of your parents. And generally, as long as you're a full-time student, less than 24 years old, you are going to be considered legally a dependent of your parents. So this is a conversation to have with your parents. I tell all of my clients, I said, listen, when your kids, and I don't mean to make you seem younger, but when your kids get those W-2 forms, the best thing you can do is go grab that W-2 form and set it aside and have a discussion as a family about, hey, what are we going to do at tax time? Let's talk about that whole thing, dependent versus independent, because this is a question I get asked by a lot of people in your age group. A dependent is someone else provides most of your support. What that means is that as your parents, they're providing you with food, clothing, and shelter. So as that, and I say here, it's usually your parents, they get to take a deduction for you as a, quote, dependent. That means you can still file your own tax return, but the way you file it is slightly different. There's a question on there that says, will you be claimed as a dependent on someone else's return? You got to mark that box, yes, especially if you're doing taxes online, because if you don't, what happens, and I see this a couple times every year, you file your tax return and then your parents go to file their tax return and the IRS sends an error message and says, wait a second, your son or your daughter already filed a tax return and they said they weren't your dependent, and then your parents are going to be upset with you. Because somebody like me, if they're coming to me to get their tax done, they're going to say, we've got a problem here, and they're going to have to go and do what's called an amended tax return to fix that mistake. So just be aware of that. Now, if you've reached a point where you're not a full-time student anymore, you're living on your own, then you probably are not a dependent of your parents. But I just wanted to put this in there because I knew the age of the people that I'm talking to here. Let's talk about what you need to file a tax return. This is kind of funny. Like I said, this is tax time for me, so I've got people calling and scheduling appointments, and they always ask me, okay, what do I need to file a tax return? Here's what you need. You need to know your Social Security number. The Social Security number is basically the go-to number for any kind of interaction you have with the tax service. So the U.S. government has a branch called the Internal Revenue Service. The Internal Revenue Service who manages the tax system for the U.S. government. Well, when you were born or soon after you were born, your parents applied for a Social Security number. You see a raise of hands. Does anybody know, do they have a Social Security number? Do you know what your Social Security number is? What I will tell you is I didn't honestly know mine until I went to college, because then when I got to college, everything was based on my Social Security number. So that's a good number to know. It's a good number to memorize, but that's a number you're going to need to file your tax return, because when you go to file your tax return, it's going to start off with your name and your Social Security number. That's what the IRS uses to tie people together. In addition to that, you're going to need to have any W-2s. So if you've worked any jobs during the year, each of your employers should send you a W-2 form. And be careful of that, because I just had a client in last night. They came in with their mom and dad, and I was doing their tax return. And I said, I see you've got one W-2 here from one job. And he says, yeah. He says, Ralph, but I also work 2 other jobs. I said, well, I'm going to need those W-2s. And he said, well, I never got them. I said, so here's your homework. You're going to have to go call those employers and figure out why you didn't get a W-2 form. So if you worked at all, you need to get a W-2 form. Now, you could also get a form called a 1099. A 1099 is when you do sort of side work. It's what's called an independent contractor. Maybe you did some work, but you used your own tools and equipment. You weren't quite an employee. That is another document that you might have. You also might get one if you had a bank account. If you have a bank account and you earned over $10 in interest income for the year, the bank is required to send you a 1099 form at the end of the year, because guess what? You got to pay tax on that earnings. If you've got an investment account, maybe your grandparents left you some money and you have an investment account, you could get a 1099 from that. Let's talk about in college. We talked about that education credit. When you're enrolled in college, you're actually going to get a form called a 1098-T form. That is a form that the college creates that says, here's how much you paid in tuition during the tax year, and you need that information in order to file your tax return. And then the final information, and this is kind of something new that's changed. Any tax return filed at the federal level, you've got to give them your bank account information if you're due a refund. It used to be you could say, I don't want to give them my information. They can just mail you a check. Well, for 2025, we're doing the 2025 returns in 2026. We're always doing those a year behind. You have to provide the IRS with bank account information for your refund. So this is a great time to say, hey, I better go get a bank account, because if I'm going to get money back from the IRS, and a lot of states are following suit on this as well, you've got to have bank information and put that on your return. And listen, don't worry, it's done in a secure method. The IRS isn't going to reach in there and grab money out of your account. I hear that all the time. They have to have this money to give you your refund. All right. So let's talk about this, how this whole process started. So we started, now we've gone through the whole process, but when you first were hired for a job, your employer should have said to you, here's a lot of them call it an onboarding plan. They give you what's called a W-4 form. The W-4 form is where you tell the employer, let me give you some information about me. You're going to put on that W-4 form your name. You're going to put in there your Social Security number. You're going to put in there your address. You're also going to tell them how you intend to file your tax return at the end of the year. That's important because they are going to use that W-4 form to decide how much they're going to take in taxes as you go. The reason you give that is, let's say, for example, you're married. Well, you may not have to pay as much tax because the tax tables, the amount that you pay in tax, depends on your filing status, whether you're married or single. It depends on how many children you have, how many dependents you have. So when you create this W-4 form and give it to your employer, you're basically saying to them, here's my estimate of what I want you to do. Here's where this is impactful. If you tell them to withhold a very small amount of tax, like you say, you know what, I'm not going to make that much money, don't withhold anything, you might owe at the end of the year. So one of the things I tell young people all the time is maybe set your withholding to be the maximum withholding. That way you know you're not going to get yourself in trouble. You just say, I am just a single person and I'm not taking any credits at all. That's sort of the easiest way to keep yourself out of trouble. At the same time, you could do that and you could get a big refund because you still have those standard deductions we talked about. You might have some credits. The whole goal here is to not get surprised at tax time. This is where the filling of that W-4 form at the beginning is so very impactful because this is basically your estimate to see what it's going to look like at tax time. All right. I've reached the end of my slides. I'm going to leave plenty of time for question and answers, but this is my big takeaway for you today. Taxes aren't scary. They don't have to be scary if you're familiar with them. And that's why your instructor, he wanted me to talk to you guys today, ladies and gentlemen, excuse me. He wanted me to talk to you because he understands as well as I do that if you understand something, it puts you ahead of the game. If you understand what your pay stub looks like, if you understand that W-4 form, if you understand all the components to that, you can do more than most adults. Most adults don't have the knowledge that I just shared with you on today's presentation. And then it comes to tax time, they're not sure what's going to happen. So I just want to say that is really the big takeaway. And that way, I'm going to give you an opportunity to ask any questions you have. And like I said, I've been doing this for 30 years, so I don't think you're going to throw something at me I haven't heard before, but I would certainly love to hear your questions, or maybe you've got some comments about some of the things we talked about today.
I have a question about when you have old jobs and not being able to get a form. So I think that was just where they give you kind of like a pretty old job, maybe like 2 years ago, they don't really give you much of the answer. What if like something for bills to be able to still get the money back from that?
I apologize. It's kind of muffled. Can you just repeat to me what you said? I apologize.
Yes. About the part where when you need the form, if you were to work at an old job and still try to get money from there, if it was like a job you might have worked there like a few years prior, and maybe you're not like had the same manager or you're not even talk to people, you might not think that you give you all the information that you need, like where you need to be able to make sure that you get your money from the job.
Are you talking about if you had a job and the employer is no longer in existence anymore and you can't get a hold of where to get their information? Is that what you're asking me? So that happens sometimes. There are situations. It happens more often than you think. So one of the things that I want to tell you to do is make sure as you're working, keep your pay stubs. Make sure you keep those things because I've had circumstances where it happens a lot in the restaurant industry. It's kind of interesting. A lot of restaurants end up closing down at some point throughout the year, and then nobody picks up the slack at the end of the year and actually sends out those W-2 forms. In that case, what we have to do is we've got to go back and look at your pay stubs and say to the IRS, hey, Our employer didn't give us a W-2 form. I hope that answers your question. The other thing I will tell you to do, and a lot of people don't think about, is keep those pay stubs and match them up to your W-2. Because I've seen there be errors sometimes. If the employer makes a mistake somewhere or forgets about something, make sure that that ending pay stub is actually equal to what's on your W-2 form.
Okay, so as long as you have proof of pay stub, we'll be able to get you.
Well, I would love to say yes, but unfortunately, it gets complicated. So yes, the answer in general is yes. But if you have that process, I'm going to tell you right now, your tax return is going to take a while because you can't electronically file your return at that point. You have to use the old snail mail, what they call paper filing, and you have to do what's called a composite W-2. You basically create a W-2 for yourself based on the pay stub that you receive from the employer. It doesn't happen very often, but it does happen. And then what happens is you send that composite W-2 and all your proof, your pay stubs and anything you have to the IRS, and then a person at the IRS will actually look it over and make a determination and say, hey, is this legitimate information? The reason they do that is there's been some scammers out there who have tried to create bogus W-2 forms to create refunds that people didn't deserve. So the IRS is very skeptical of that. But I do see that. I've seen that many times in my career where you work for somebody and then all of a sudden they didn't have anything, which brings me to another issue, which a lot of people don't think about. Make sure your employer is giving you a pay stub. Make sure on that pay stub you're seeing taxes come out. I was working with a client just the other day, and they worked all year long. And he said, I thought it was strange, Ralph. He said, all year long, they just paid me what they told me I was going to get, but there wasn't any taxes taken out. Well, they were doing what's called working under the table. It was an inappropriate relationship. It's an illegal relationship. And then at tax time, it's a big problem because now all of a sudden, none of the income was reported. So now we've got a dilemma because even though your employer didn't report that income, technically, because you got that economic benefit from it, you got the money, you're supposed to report that on your tax return. But they didn't withhold any taxes. So now you might owe taxes on income that they should have taken all along. I hope that answers your question.
For the return, if you pay too much, is there like a fee that you have to pay?
Okay, great question. So what you're asking me is if you're due a refund, if the IRS owes you money, do you have to pay a fee? No. Here's the problem with that though. They don't give you any interest either. So if you've been paying it all year long and they owe you money, guess what? They'll give you what they owe you, but they don't give you anything for using their money. But let me answer that question a different way. Let's say that you do owe them money instead of getting money back. If you owe them money, they can charge you a penalty for not paying enough in throughout the year. So I hope that answers your question. But no, generally there's no penalty for getting money back. Here's the thing I wanted to warn you about though. You only have 3 years to ask for a refund. That's why it's so important that you file all the time. I worked with a client, it's probably been about 10 years ago, who hadn't filed tax returns in 10 years. Just didn't want to do it, didn't understand, didn't want to. Well, we went back and redid the returns because finally the IRS said to him, hey, you need to file returns. The tragic part of this is every year they were due a refund and they did not get any of that money back because the IRS says we only have to issue refunds within 3 years of the tax filing deadline. So to answer your question, no, they don't charge you a fee. They actually love using your money for free, but make sure you're filing returns timely so you don't lose those refunds.
As a minor, how much of your taxes do you get back?
It depends. And I hate to say it that way. It depends on your situation. Generally, you have a certain amount that you can earn before you pay any taxes. In general terms, it's around $13,000. So if you make less than $13,000, you're generally going to give back any taxes you pay in federal tax or state tax. You do not get back anything you pay in Social Security or Medicare tax. Once you get over that number, then you actually have and the reason you have that is because we talked about that standard deduction. So no matter what you are, you get a certain amount of standard deductions. What you don't get is a credit. We mentioned a little while ago that your parents get what's called a child tax credit. Right now, the child tax credit is $2,200 per child up to the age of 17. Then once you turn 17, your parents get $500 for you as a credit. The difference is when you file your own tax return, if your parents can claim you as a dependent, you don't get that credit. But you basically still have that standard deduction threshold. So I don't want to tell you exactly what it is, but around $13,000, you're not going to pay any federal or state tax, but you will still pay Social Security and Medicare. But don't worry about that because that's already coming out of your pay as you go.
How much did you say was to file your taxes again?
How much does it cost to file your taxes? Yeah. It really depends. I mean, honestly, you can do your taxes yourself. It depends on the complexity of your return. You can do them yourself. It won't cost you anything. If you go to a tax professional, it really depends on who you're getting. There are places at some of the, like Walmart and some of the malls where you can go and find somebody that does taxes once a year. Those folks are probably less expensive. I will tell you personally, my minimum fee to prepare a tax return is $400. That's what I charge. That is for your federal tax return and your state tax return. But I actually am a professional, have a license to do this. And it's one of those things I say to my clients all the time, you get what you pay for. I've been doing this for 30 years. I understand all the little nuanced pieces of this. So a lot of people come to me because they might have a complicated situation. Like your instructor had a complicated situation because he had a certain situation because of his visa. There were certain tax rules and regulations that he had to follow. Something that's not easy to do on your own. But honestly, if you've just got one W-2, you worked one job, it's not real complicated. I wouldn't expect you to pay very much to have that done, or you can really do it yourself. And that's the thing I encourage a lot of people is to go try it themselves and then take a look at it. If it makes sense, there's a lot of places online. Just be careful with your data. Make sure it's a reputable place because you're putting your name, you're putting your Social Security number, you're putting your date of birth on there. Or the other thing I encourage my clients is ask your parents about it. Where do they have their taxes done? And say, hey, would your tax preparer be able to do this? And find out what that would cost. But it could vary, honestly. It could be anywhere from $50 to, I've got some clients that have very complicated tax returns where they may own rental properties or they have businesses. We charge several $1,000s a year to do their taxes. So it really depends on the complexity of the return. I hope that answers your question.
Thank you, sir. Next, Ben.
Sir, I have a question about the owing money after taxes and does that reflect badly on you, like in any type of way? Like, just say you're working a job and then you owe money on your taxes. Does that do anything negative to your career per se?
No, not at all. But a couple of things we need to understand about that. If you owe, when you figure that out, you got to figure out why. So if you owe because you don't have enough withholding, then you got to go back to your employer and change that W-4 form and say to your employer, listen, I did my taxes and I owe some money. It's not like a credit issue. You're not going to get in trouble because you owe them. If you owe them and you don't pay them, that's a different discussion. If you owe the IRS and you don't pay them, they can come after you. They can attach your wages. They can file with the court. They can take your money from you. They can take away your passport. They can take money out of your account. So it's very wise. Now, all that said, the IRS wants you to pay them. If you find yourself in a position where you can't afford to pay them, first thing I tell all clients is go ahead and prepare the tax return and file the tax return. Because if you file the tax return, you're in compliance. That keeps you out of trouble with the criminal side of things. You're not doing tax evasion. The IRS will work with you to develop a payment plan to get paid back. But here's the thing you got to understand. They're going to charge you interest and they're going to charge you penalty until that tax is paid. But it doesn't impact you negatively. It just means, hey, something's going on here. I need to change something. Because what happens to a lot of people, and I love your question because it's perfect. They just see that they owe, and every year they owe, and every year they owe, and every year they owe, but they don't change anything. And then what happens is they get buried in this tax debt, and it just rolls forward and forward and forward. Like I've got a client right now that owes about $200,000 in taxes because every year he just doesn't pay it. And he doesn't pay it. He's got a small business, so his is more complicated. But at some point, the IRS is going to do what they call a levy, where they're going to go and put a lien on his house so that if he ever wants to sell his home, the IRS is going to say, no, you pay us first. If you owe more than $50,000 in taxes, the IRS can revoke your passport. They can make it so you can't travel, you can't leave the country. But to answer your question, it's not a big deal, but understand what's going on and make sure you change it so that you don't owe again.
Thank you.
You're welcome.
Sorry, one last question, sir.
So how often should I keep up with my tax filings throughout the year so I don't get into that debt?
Okay, you said how often do you have to keep up with your tax filings throughout the year? Oh, okay. Yeah, so you have to file a tax return every year. It's due on April 15th of the year after. So right now, I'm doing all 2025 tax returns. So that is the one time a year. Now, that said, what I think you should be doing is looking at your pay stub every time you get one and saying, are they taking out federal taxes? Are they taking out Medicare and Social Security? Here's another thing to look out for. You might have an employer that has multiple states where they work. Make sure they're taking out the state where you actually work and actually live. Because I've had clients, especially we're so close to Maryland, it's sometimes maybe you work in Maryland, you want to make sure they're taking out the taxes in the state where you work. So that's the thing, to check out your pay stub. Don't wait till the end of the year. Like I'll give you a funny example. I had a client, he was a school principal. It's probably been 20 years ago. And all year long, he said, I thought it was weird. I kept on getting more pay than I should. Well, when he came in to get his taxes done, we realized his employer withheld zero in federal taxes. Zero. So when we did his tax return, he owed a ton because for some reason, when he filled out that W-4 form, his employer thought he wanted to be exempt. So they took out no taxes. So that's the thing. So yes, you have a compliance requirement at least annually, but pay attention to what's going on throughout the year so you don't have a big surprise come April 15th.
Thank you, sir.
My question is, I work construction and I've done work in Pennsylvania and New Jersey. And on my pay stubs, I see that they take tax out for both states. I was just wondering if that affects the way I file my taxes at all.
It does. Great question. So the way taxes work is you pay taxes in the state where you work and you pay taxes in the state where you live. But most states give you a credit for taxes that you pay in other states. So let me talk about your example directly. I'm assuming you live in Delaware, but you said you worked in Pennsylvania and New Jersey.
Yes.
So what's going to happen at the end of the year, your federal return is going to be the same, but you're going to have to file a New Jersey tax return, you're going to have to file a Pennsylvania tax return, and you're going to have to file a Delaware tax return. When you file your Delaware tax return, you're going to have to attach copies of the Pennsylvania return and the New Jersey return because Delaware is going to give you a credit for the taxes that you paid in those other states. So they don't double tax you. But yeah, you've got a complicated situation. So if you have that situation, that's when you're going to reach out to somebody like me that says, hey, I got a complication here, because that one is not easy to do online on your own. Does that make sense? So yeah, you're going to have to file in each state. But yeah, so yours is a little bit more complicated.